Let's start with the regional banks, if we could. First of all, give us a sense of who are these regional banks? How many are they? How important are they to our banking system?
Well, it hasn't been a great 6 months for these banks, David, has it? Essentially, the way it's probably most useful to break them down is if you look at the banks that have between about 50 billion in assets and about 250 billion in assets, which are generally termed mid-sized regionals. They collectively, there are about 25 of them, and they collectively account for about 20% of U.S. commercial banking assets. Now, that compares to almost 40% for the four big universal banks. So they get dwarfed by those four big banks, but it's a non-trivial amount of lending that they do. And their lending is concentrated differently than that of the biggest banks. They're very important suppliers of capital, of credit to mid-size companies in particular.
So Dan, as you say, they haven't had an easy time of it in recent days. Are the federal regulators doing anything to make it easier? Because we do have these downgrades, of course, and now we hear the FDIC is going to require longer-term debt to be held, I guess not to avoid a failure, but in case of a failure to help pay for it.
Correct. So what's going on now, obviously, David, is in significant, though not total part, a reaction to the failures of Silicon Valley, Signature, and First Republic earlier this spring. And specifically, of course, the fact that all three of those banks had huge amounts of unrecognized losses on their bond portfolios, the treasuries and agencies that they held. And that, of course, is because of the rapid rise in interest rates that has occurred over the last year and a half. So I think the agencies absolutely felt that they needed to respond to that. But that intersects with two pre-existing regulatory initiatives. First, the Basel III Endgame, which was going to raise capital for the over $250 billion banks in any case. And the agencies then extended that down to $100 billion because of those failures. And secondly, as you mentioned, the long-term debt requirement. That, by the way, is not something that the agencies have come up with since Silicon Valley. That idea has been kicking around now for the better part of a year. The agencies have been talking about it. So the regulation is going to get tighter at the same time that these banks really are facing, I think, a real challenge to their business model over the medium term.
So, Dan, at 40,000 feet, apart from the plight of the individual banks and their shareholders, do we need strong regional banks? I mean, you pointed out you have the small, the community banks, the local banks. They have personal relations with customers. You have the big guys, the G-SIBs, on the other hand. Do we need something strong in the middle?
My sense is that if we're going to have a more competitive banking system, we are going to need some restructuring from where we are now. I think it's most likely that the way that would be achieved would be to, double or maybe more the number of banks that are, in the 400 to $700 billion range that can get adequate scale to be able to function efficiently, but at the same time are well short of being G-SIBs. And I think, but where we are now, we may just see some of these regional banks just kind of atrophying. And the question becomes, where does their business go as they atrophy? Hopefully don't fail, but they just shrink over time. And I suspect that at least a part of that business is going to go to the four universal banks, which would be an odd outcome if one's policy aim is to increase competition.
Let's talk for a moment about the big banks, the G-SIBs as they're called. There's a proposal now to increase the capital requirements for them, the regulatory requirements for capital. Do we have a sense of what the right number is for reserves? As you know, a lot of the big banks are sort of complaining, grousing about the fact that they have to have more capital.
Well, complaints from banks about increased capital requirements are a perennial, so in and of itself, that shouldn't surprise us. But we still do want to make a kind of cost-benefit analysis, a sort of social welfare analysis to see if this is good policy. I think it quite probably is for several reasons. One, the weight of the academic work that's been done to date suggests that the optimal trade-off between financial stability with higher capital requirements and more financial intermediation, economic growth, probably lies somewhere in the 14–15% range of capital as a percentage of risk-weighted assets. We are fair amount below that right now for the biggest banks. Even with the stress test requirements, they come in somewhere between 8, 9, 10, up to about 13%. So that's number one. Number two, in all honesty, the stress test, which we've relied on as the best risk-sensitive indicator of how much capital banks need, has become more and more predictable over time. This year was a little bit more creative, but for the last 5 years or so, it's become more predictable. And thus, it doesn't serve as much of a purpose as it used to. It's more like a compliance exercise, which tells us we shouldn't get as much reassurance from it as we did before. And third, to me at least, the prospect of resolving, putting into bankruptcy or FDIC resolution one of our global systemically important banks is not a very strong one. If they get in trouble, it's almost inevitable, I think, that the government is going to end up giving some sort of assistance directly or indirectly. So if we want to have market discipline, we want to stop that from happening, I think capital requirements need to be somewhat higher. Now, having said that, I think it's incumbent on the banking agencies to dig into those analyses of optimal capital levels, the trade-off between financial stability and economic growth, and to explain in a way that's accessible not just to experts, but to the public, why these capital increases are warranted.
Dan, we've been talking about bank regulation. Let's have one moment at least on macroeconomics and monetary policy. As you know, we've been having those Jackson Hole meetings out in Wyoming. I won't ask you where they're going with the interest rates right now, but in a longer term sense, there's a lot of discussion about whether we are headed toward longer term higher rates or lower rates. And there's a debate, as you know, among economists and others right now. And they talk about R-star and neutral rate and things like that. Where are we right now? Is this going to settle down, or are we facing a fair amount of uncertainty right now?
Well, David, you mentioned R-star, and R-star, that is the neutral real rate of interest, is one of what I and others call the invisibles in monetary policy, which is to say you can't derive it from real-time data. It's a concept where the real interest rate needs to be in order neither to promote nor retard growth. It's something that, at best, I think, people can determine in retrospect, having seen what's happened in the economy in the past. But I don't think it really is a guide for real-time policymaking. You know, it's interesting, David, the very concept of the natural rate of interest was first developed back in the early years of the 20th century as a guide to what banks should do under the gold standard. You know, the natural rate was the one that resulted in an equilibration of inflows and outflows of gold. That's something that could be observed. Gold was flowing in, gold was flowing out. We really can observe what the natural rate is in a fiat money economy. And so I think, as useful as an intuitive device as it is, I don't think it really helps us much in making monetary policy. Having said that, I think why you've seen these little frissons in the market is because of the prospect of the Fed in its summary of economic projections in September, maybe suggesting that the natural rate has gone up, which in turn would suggest that rates are going to stay higher even when the Fed thinks that it's done enough with inflation.